Well, hey, everybody. Welcome back to the Confident Retirement Podcast brought to you by LPF Advisors. It's 2026. This is our first episode of the year. And I'm your host, Kris Flammang, and I'm joined by my co-hosts, Colin and Armando, who will help us to break down our topic today. Speaking of our topic, I smell, what do I smell? I smell taxes. I smell the
New
IRS.
tax law.
Yeah, we're going to talk about the new tax laws. New tax laws are in the air. So we're going to go over that today, but we're diving into it. It's creating a lot of questions, but we're going to try to take the noise out of it, and we want to try to slow it down today, explain what actually matters, and talk you through how these changes affect real people, real business owners. So we'll jump in a second, but first I want to give you our disclaimer. The information that we provided is our opinion and not necessarily that of this platform or our firm. We provide general information only on the podcast and not any specific customized investment advice. Nothing should be construed as financial, tax, or legal advice. You should consult with your own professionals about your personal situation. Okay, so we've got like 8 or 9 bullet points here. We're going to fly through them. We've got a timer. Ding.
There was a lot.
All right, that's right. Armando, let's jump in.
Of course, yeah, first podcast of the year. So, Colin, let's start big picture. One of the first things that jumped out to me was the estate tax exemption. Can you tell me what changed?
Yeah, so this is one of the biggest ones, Armando. So the estate tax exemption was set to drop this year, but that's changed. They're actually making the exemption higher. So now it's 15 million instead of 13 million. It was set to drop to 6 million this year, but they ended up changing that. And not only did they increase it, but now that change is imminent. So even for a married couple, their exemption is going to be 30 million, which they can pass to their heirs completely tax-free.
Wow,
Okay,
15
yeah,
to 30 million.
there was a little blip there. So Colin said that it was made permanent. I just want everybody to understand that.
Yeah, it's permanent and 15 and 30 million. Wow. So basically, this change mostly affects very high net worth families.
Yeah, it also, I mean, it affects planning decisions for people who may grow into that range. So maybe not people that are there right now, but there's a lot of planning opportunities. It changes how aggressively you need to fund trust, gifting strategies, or wealth transfer strategies. Even if you're not there today, this gives more clarity long term.
Well, it's always good to plan ahead for that. And another change I saw had to do with state and local tax deductions coming back into play for more people.
Yeah, this is one of my favorites. So the salt deduction cap used to be stuck at 10,000, which meant itemizing didn't make sense for a lot of households. So now if you earn under 500,000, you can deduct up to 40,400 in state and local taxes. So what that means, you can deduct your state taxes for people that live in New York, Massachusetts, California, et cetera. But also you can deduct your property taxes as well, your real estate taxes. So this pushes a lot of people back into itemizing.
Yeah, good information. That's definitely a big difference from the change. And so once you get above a certain income, does it go away again?
Yeah, so that phase out starts at that 500 level. Once you increase above 600,000 of income, that cap actually drops back down to 10,000. So it's very income specific, which makes planning more important than ever now.
Of course, understood. How about charitable deductions? I heard those got a little less attractive for higher earners.
They did. For non-itemizers, there's still a small deduction, $1,000 if you file single, $2,000 if you file married filing jointly, which is nice. But for itemizers, there's new limits. Charitable deductions now have a minimum threshold of 0.5% of your income, and deductions are capped at the 35% rate, not the 37% rate anymore.
Of course, we all know giving is important. So giving still matters, but strategy more so matters more.
Absolutely. So tools like donor advised funds still make sense, but you want to be you have to be a lot more intentional with those gifting strategies.
As it should be. This new feature caught my attention. I'm sure it caught everyone's attention. Trump accounts. Colin, what are they?
Yep. So this is the one that everyone's talking about. So for children that were born between 2025 and 2028, the federal government is going to make a $1,000 contribution to these, Trump accounts. They're for kids under 18, but if your kid was born between 2025 and 2028, you'll get that initial seed money of $1,000. A beginning of July 5th of 2026, parents can contribute $5,000 pre-tax, and businesses can actually contribute $2,500 post-tax. Sorry, pre-tax for the businesses, after tax for the individuals. But the real kicker is the account can be converted into a Roth IRA at age 18, subject to the IRA conversion rules.
Yes, I'm even thinking about having some kids now just for this.
$1,000.
I got 3 sons. They're almost out of high school. Why don't I just start over so I can do a Trump account?
I think it'll be worth it. I'm sure you got until 2028 to take advantage of that. But yeah, I mean, isn't it lucky if you had a child born between those years, 2025 and 2028?
Yeah, I mean, it's huge for generational planning. You're basically giving your kids a head start on tax-free growth. But when you do take that money out, just remember that money that you do take out will be taxed at ordinary income rates, similar to how an IRA is taxed.
But that's
Gotcha.
unless you convert it to the Roth, right? So if it got converted when they're 18, then you're out of the woods on that.
If you convert it, you'll pay taxes on the amount that it grew to for any money that was after
Okay,
tax.
on the conversion. Okay, got it. Thank you.
Yep, gotcha. For our next topic, it seems like, they do this every year, but did retirement contributions go up?
Yeah, across the board, IRAs are now 7,500 from 7,000. 401ks are up to 24,500. And business owners that are using the solo 401ks or SEP IRAs, you can actually get up to 72,000 in there, including mega backdoor Roth strategies now.
The more the merrier. Yeah, that's definitely a big opportunity if your cash flow allows.
And don't forget the catch-ups, right, Armando?
Yes.
So the catch-ups still apply for people over 50. And there are some limitations now if you make more than 150,000 on where your catch-up contributions can go. So we might do a separate episode on that. But if someone has specific questions about that, they could reach out and get in touch with us.
Yep.
Yeah, so let's pivot to business owners now. So bonus depreciation back?
Yeah, and it's permanent. So anything with a 15-year or shorter depreciation schedule can now be fully written off in year 1, which is huge. So equipment, certain real estate components, all of it can be written off in that first year.
I'm assuming that's definitely going to be a dramatic change to business owners and their tax bills.
Huge impact, especially in those growth years.
Good. I could imagine. So, all right, finishing up here. Seems like seniors have new deductions to look out for.
Yeah, they do. So starting in 2025, if you're 65 or older, there's a new $6,000 standard deduction per person, and $12,000 if you're married and filing jointly. So huge deduction for people over 65.
Yeah, that'll be definitely important for tax planning. Seems like there's income restrictions on most of the things we talked about. Is there any income restrictions to get this benefit?
There's always rules around it. Out of individuals making 75,000 or married couples making 150,000, that's where it starts to phase out. We have to keep in mind that this rule is also temporary until 2028. But bottom line is that this could mean thousands of dollars less in taxable income if you don't itemize.
That's a good place to end. This is kind of exactly what we wanted to do with the episode. The headlines and the internet searches and all the pop-ups seem to make things really confusing. But when you break them down, there's some real opportunities there for people planning wise and for the clients we serve, especially with the right guidance. So if any of our listeners today have more questions about this or other financial topics, they can feel free to reach out to us at lpfadvisors.com. That's our website. They can also email us using info@lpfadvisors.com. Please be sure to subscribe to the podcast. We put episodes out periodically and try to make those timely. And share the episode with somebody else if you found it helpful. We want to thank everybody for tuning in to the Confident Retirement Podcast today. We'll see you next time. Until then, take care. Be well. Thanks, guys.
Awesome. Thanks, everybody.
Thank you.
Thanks for listening to the Confident Retirement Podcast with LPF Advisors. For more information, please visit lpfadvisors.com. If your ears are pleased and your mind at ease, do share this program with your friends. To subscribe wherever podcasts are found.